Well, hello, everyone, and welcome to the Benjaminzmiller Investor Networking Group. It is so nice to see everyone here today. We have a very interesting topic that we're going to discuss today, and that topic is mortgage note investing. I'm going to talk about some of the basics of mortgage note investing, but I'm going to go into a few things that a lot of people don't think about with mortgage note investing, because you can find a lot of people that maybe they talk a little bit about mortgage note investing, buying debt. But the thing that is different in this presentation is we're going to also really consider the real rate of return when you talk about the movement of different currencies. So that if you're getting, for example, an 8% rate of return on a US mortgage note, and you're getting an 8% rate of return on a mortgage note that's denominated in British pound sterling, we're going to look also at how big the implications are there with the exchange rate, and how that's something that you should also be thinking about, the real rate of return. So I'll just go through the slides here, and then I'll take any questions at the end, and we'll get started. So the first slide is what is a mortgage? For those of you, everybody knows what a mortgage is, but it's actually very interesting. It comes from a French word. It comes from the Old French, and it literally translates as dead pledge. And the reason that it was called that was years ago, when people would take out these mortgages, they would not live until the end of the mortgages. And actually, that is something that is interesting about the mortgages, the fact that you can obtain long-term income, years and years and years of income when you purchase a mortgage. A lot of people, they talk about purchasing real estate. We all know about that. But a smaller percentage of people that are interested in being what's called a lien lord instead of a landlord, mortgage notes, they really provide this sort of an opportunity. So I'm going to show a short clip here. This is about a 6-7 minute clip, and it is talking about one of my companies. This company is called Alamo Mortgage Holdings. Alamo Mortgage Holdings is a United Kingdom company that actually purchases American mortgage debt. And I'm going to talk about why a UK company and why American mortgage debt, because there's a very real reason for that setup. But this will talk a little bit about how this works, and then I'm going to go through some other slides and some more information. So I'm going to go ahead and play the clip now. And if you need the sound a little bit louder, let me know, Mark, okay? First, I want to go through an important notice. I want to make this absolutely crystal clear. This investment is only directed at persons certified as high net worth investors. So if you're not a high net worth investor, we are not offering this to you. We're not trying to sell this to you. Before making any investment, you should read the information memorandum, and you should make sure that you understand the risk factors. This is not an investment with zero risk like a government bond. This does have risk, and I'm going to just tell you that there's always a risk that exists in investing. But as experienced investors, I'm sure you already know that. So your capital interests are at risk. Okay, so let's talk about the mission of Alamo Mortgage Holdings. The mission of Alamo Mortgage Holdings is to provide passive income to non-U.S. accredited investors. So we're not looking for U.S. accredited investors. We're focusing on United Kingdom. We're also focusing on institutions by purchasing real estate-backed mortgage notes in the United States, in the state of Texas, while providing greater liquidity to the owners of these mortgage notes. Alamo will earn money by purchasing mortgage notes at a discount. We're going in and we're negotiating hard to purchase those mortgage notes at a steep discount. And then once Alamo has that mortgage note, we're able to pay out fantastic returns to our bond and note holders. As an example, let's say that you purchase a private mortgage note that has an unpaid balance of $100,000. And let's further imagine that this hypothetical note has a 10% rate of interest. Let's say that you find a motivated seller, they just need cash, they can't wait 30 years for the note to pay off. And you say, well, I'll pay you, Alamo says, we'll pay you $70,000 cash today for the note, and we'll wait for years to collect the payments. To the right motivated seller,
that will be appealing. Now, I know to many of you that may not be the situation where you would never sell a note that way if you own such an asset, but there are motivated sellers in the world, and we provide a service to those motivated sellers. We're able to get them the cash they need where they cannot easily turn those notes into cash. And in exchange for that, they have to make it attractive for Alamo. So after the purchase, the borrower is now our borrower. So now we have a borrower because we bought the mortgage note, and that borrower that was making payments to the guy that sold us the note, now he has to make payments to Alamo Mortgage. This borrower has now, but his payments have not changed, even though we bought the note at a discount. So our yield on this hypothetical note is 14.2%, allowing us to pay out 8% passive returns to our bond investors. You know, folks, the current low interest rate environment, it really does not provide many options for investors to earn passive income, while also having the safety of capital preservation. Alamo Mortgage Holdings solves this for our investors, for our bondholders, for our note holders, by focusing on acquiring mortgage debt, hard assets, collateralized assets, exclusively in the state of Texas. We have a very focused niche market. We're not a company that's trying to do business all over the United States. We focus on one state. We know the laws in that state. We've got a team that's from that state. We've got 200 years of business experience and 100 years in the mortgage industry. And that's our business. And we are able to offer this passive income to you. We can supply it, and it's something where you can do one investment and for years you can earn passive income. It's not something where you have to do a lot of analysis of each mortgage note. We handle all that for you. So let's go to the next example. Let's say here that there is a property, a piece of real estate in Texas, and the price of it is $120,000. This is a real property. This is an example. This is not something we have in our portfolio. I'm just trying to demonstrate the concept. So this property is worth about 100,000 pounds, and the buyer put down a $20,000 US down payment. So he bought it for 120,000 and he put down 20,000. And this created a situation where the seller created a note at 10%. Now you might be thinking, why in the world would anyone pay 10% on a mortgage? Well, folks, the reason for that is a lot of people, they may not be able to get a mortgage from the bank. They go into the bank and the bank says, you know, you don't have a high enough credit score. You don't have enough work history. You're self-employed. No mortgage. We won't give you a mortgage. And these sorts of people, they still want to buy a home. They're good people. You know, they still want to make their mortgage payments, but they're cut out of the market. They just don't have the option. And Mr. Seller, of course, Mr. Seller would rather sell it for 120,000 cash to a cash buyer. But you know what? No cash buyer showed up. He put it on the market. He tried to sell it and he couldn't. So now this situation has been created. And as a result of this situation, in this type of situation, the seller was not able to sell the property, but found a buyer that wants the property. And the buyer said, listen, please, I want a house. I'll pay you $20,000. Please let me make mortgage payments to you. And the seller said, I don't know. I mean, I really wanted that cash for something else, but I am at the point in life where I don't really need the cash that much. But if you pay me a high enough interest rate, I might do it. So they negotiated and they agreed on a 10% rate of interest. This is typically how this sort of note might be created. Now, it's a 360-month note, a 30-year mortgage note, and the monthly payments they work out at a 10% interest rate. It works out to a monthly payment of $877.57 per month. So now we have the opportunity to buy the note after 5 years. Have gone by. It could be any number of years, just picking a round number as an example. We kind of prefer to buy notes that already have some seasoning on them where they know the payments are being made. So that means there are 300 payments remaining on that mortgage note. The present value or the current balance owed on that note would be $96,574.32. Even though 5 years of payments have been made, we know how amortization works, where in the beginning of that sort of a loan, the majority of the payments going to interest. So that's one of the beautiful things about mortgage notes. So if we wanted to, or you wanted to earn a 12% return on your investment, you could pay a maximum. The highest price you could offer to that seller is $83,322.39. Well, of course, you're going to try $60,000. You're going to try $70,000, but there's a balance in there, and that'd be the highest you could go if you had a limit of I have to get a 12% return. So that means your investment to value, if the seller agreed to sell that note, is at 69%. There is literally $36,000 of equity in the property. I practically hope that the buyer doesn't make the payments. We'll take that